Hey everyone, this is Finding Value. I just kind of want to talk about a couple of things. So we've got cycles, and these cycles are typically long. Sometimes they're 20 to 40 years. That's the secular cycle, and you've got the cyclical cycles. I just talked about that in another video. And in order to become a successful investor, you have to understand the cycle you're in so you can maximize your purchasing power gains. Otherwise, if you're not making purchasing power gains, you're failing as an investor. Sure, it may go up in dollar amounts, but if you can't buy more of another thing, that if your investment is going up less than all the other investments, then you're obviously not making purchasing power gains. And the whole point of investing is to increase your purchasing power against whatever other things that you want to purchase. So it's important to understand the cycle. But within, we still want to buy the best value within the cycle that we have. And we do this on a daily basis. And I'll make an example here. A cycle is something like, let's say you've got summer and you've got winter, and that's a cycle. The value of purchasing something is different throughout that cycle. So the value of, let's say, swimwear is probably pretty low in the fall and winter. And as an investor, you're probably wanting to purchase in the fall and winter swimwear because it's going to have the lowest price. They're going to discount them way down, and you can buy that for a very good price in the fall. Conversely, you probably want to buy a snow shovel in the summer or in the spring, somewhere where it's out of cycle and people don't want it. The demand is low and maybe the supply is still there or high. So you get the best value. When you go to purchase a house, what do? You go and you look at a bunch of homes. You find out kind of roughly what they're asking, and eventually what you're going to do is you're going to find the best value. You're going to say, man, this thing is underpriced because it has a 3-car garage, it's got 4 bedrooms, and it's in very good condition, and it's 10 or 20 grand less than all the other homes in the market. Therefore, it is a good value. In investing, people kind of just throw that out the window. They're like, yeah, whatever, right? So in investing, what we're looking at is we've got ratios, and those ratios are basically telling you the value. So the ratio is like doing what you're doing when you look at house prices. It's doing what you're doing when you look at products that you want to purchase and you're evaluating, let's say, different car models. You're saying this one's a better value because it has X features and it has a reliability behind this brand versus this other car. A ratio and plotting it is the same exact thing. You're just saying, I want to purchase this when it's out of cycle at the cheapest price, and I want that when it comes back into cycle, going from buying swimwear in the winter to swimwear in the summer, that coming into that cycle, the prices are going to rise. So we're just buying the out of favor asset and waiting for all the people to run to it or when it becomes in favor. Another thing that I look at is a lot of people look at risk and volatility. Volatility is synonymous with risk. If you can stomach the moves and you are looking at the ratios and finding the value, you want the most risky, volatile assets out there because they're the ones that are going to move the most. They're the ones that are going to give you the largest gain over the shortest period of time. So if you understand the cycles and you can find the value, so you identify where we are in the cycle and you identify the value, the ratios, to find the most underpriced assets and buy those underpriced assets right before or in the middle of their cycle, you are going to increase your rate of return quite dramatically. The problem that people get into is that when they don't understand something and they don't know how to value it, of course it's going to be exponentially risky because they know nothing about it. What this channel is trying to do is understand the cycles and understand the value, and I'm going to share the cycle that we're in, and I'm going to share what I think is the best value by looking at the ratios and teaching everyone how to value assets against other assets. This is the only way that you can make money in the markets. There is no other way, because if you're buying an asset that is losing value against another asset, you're not making purchasing power gains. I mean, think about that for a second. You're not making purchasing power gains if you're buying an overvalued asset and writing it down. And right now, stocks are overvalued. They are the overvalued asset. They are out of cycle. They have been losing value against precious metals since 2000. Yes, we had a short cyclical uptrend in the secular trend. But going forward, precious metals are going to outperform. That's where we need to look at. And the best value on a ratio basis within the precious metals is platinum. Silver was an extremely good buy beginning of this year. It's kind of moved up. It's still a good buy. It's still relatively cheap, but platinum is even cheaper. And another thing that I look at versus other people is I look for total return. I don't necessarily look for the least amount of risk, because the least amount of risk is not going to move anywhere in comparison to a riskier asset. So what I'm banking on is I'm banking on relying on knowing where the cycle is, relying on identifying the value, and then cost averaging in, which is reducing your risk into that undervalued asset. And then waiting for that undervalued asset to appreciate against other assets. So you have to be patient. You have to identify the undervalued asset, and then you accumulate it. And sometimes the undervalued asset stays undervalued for some years. It may be 3, 4, 5, 6 years even. You keep piling into that undervalued asset, waiting for the cycle to change and come back. And it almost always comes back, always. Real estate moves in cycles, which then influences the interest rates, which then influences the stock market. Because when housing goes up, you get inflation because money's being loaned into existence. It's that multiplier. That is a fractional reserve banking system. They only hold a fraction back. So the multiplier in the banking system comes from home prices going up. We know that we're in an increasing home price environment, which means that we're probably, and they're printing a ton of money, which means that we're probably going to get inflation at some point. We do have a short-term deflation from COVID. When that inflation comes, we're in an upcycle for precious metals, and precious metals are in an upcycle when real estate goes up. 1970s inflation, real estate went way up, precious metals went way up. They had that mortgage debacle where they just gave everybody loans, home prices went way up. From 2000 to 2006, 2000 to 2011, gold went way up, precious metals. Now, we've got another real estate cycle that's going to be moving in the expansion phase. Precious metals are going to go up. Platinum's the cheapest in that cycle. Whenever you have a scare or you have a deflation worry, usually platinum goes cheap. Then when the inflation comes, it catches up. So this may stay down for a little while, which is good because now you can accumulate platinum. Then when inflation starts coming, platinum's going to catch up and it's going to move. And it's going to move very quickly. It's going to go vertical. So hopefully this talk helps you understand a little bit about cycles and value. Appreciate your time. This is Finding Value. Please click subscribe and the like button. Thank you.